The New York Stock Exchange and Nasdaq have shared effective control of American equity trading for longer than most portfolio managers have even been alive. This coming Monday, that structure gets its most well-funded, most institutionally backed challenge in modern history. By the end of this video, you're going to understand exactly what the Texas Stock Exchange's Monday launch actually means for the architecture of American capital markets, why the financial press is describing it as a regional curiosity when it's something considerably more consequential, and what the shadow data buried inside the TXSE's own regulatory filings tells you about where this is going and who actually wins. On Monday, July 6, 2026, the Texas Stock Exchange goes live. TXSE commences production, quoting, and trading operations as a fully registered national securities exchange, participating in both the UTP plan and the CTA plan. The financial press called it a test, a curiosity, a political statement by Texas about its growing financial ambitions. Wall Street treated it as a startup. Here's what the numbers say, though. TXSE raised $270 million in capital. This SEC has formally stated that this makes TXSE the most well-capitalized exchange to ever submit a registration to the commission. Not in the last decade, not since deregulation, ever. The investors behind that capital include BlackRock, which is the world's largest asset manager, Citadel Securities, the largest market maker in American equities, Charles Schwab, JPMorgan Chase, Fortress, and most recently, Goldman Sachs and Bank of America. Pretty much the who's who. When Goldman Sachs and JPMorgan are both backing the challenger, the incumbent needs to pay close attention. The SEC approved TXSE as a national security exchange on September 30th, 2025. That approval gives TXSE the same regulatory standing as the New York Stock Exchange and the Nasdaq. From Monday, every broker-dealer in the country has the option to route order flow to TXSE. That is the starting gun. The launch is phased and deliberately sequenced. Monday begins with a defined set of test symbols. Additional symbols come online in stages through July, with full symbol rollout targeted by July 31st. Exchange-traded products are targeted for September. Corporate listings, starting with dual listings from companies already on NYSE or Nasdaq, are targeted for October. This is not a stunt. This is not a stunt. This is a staged institutional build-out with a clear timeline. Don't miss that. But the mainstream financial press is missing the two details that actually tell you what the exchange will do to the incumbents. And I found them in the regulatory filings. I read those so you don't have to. Before I get into it, if you like this type of content, please click like and don't forget to subscribe. It's important to be in the know. And this, my friends, is how you do it. Okay. Here's the first thing the headlines missed. The Texas Stock Exchange's primary matching engine is not in Texas. It's in Secaucus, New Jersey. I bet you never heard of that. I know where it is. Specifically, Equinix NY6, the same exact data center cluster that hosts the core matching infrastructure for NYSE and Nasdaq. The disaster recovery engine is in Dallas, but the primary engine, the one that processes every trade, is in New Jersey. Why does this matter? Because it tells you what the TXSE actually is. It's not a regional exchange serving Texas companies. It's a competing national exchange that is deliberately co-located with the incumbent infrastructure to eliminate the latency disadvantage for high frequency and institutional order flow. It's built to compete for the same exact microsecond execution that NYSE and Nasdaq sell at a premium. The Texas and Texas Stock Exchange is a regulatory and political address. The market structure is pure Wall Street. Here's the second thing that the headlines really missed. TXSE has published listing standards that are by design, more stringent than NYSE and Nasdaq. CEO James Lee has stated that TXSE's listing requirements would exclude approximately 1,500 companies currently listed on Nasdaq and 200 companies currently listed on the NYSE. Earnings tests, minimum pricing requirements, standards engineered to build an exchange that institutional money can trust to be free of the low-quality listings that have degraded confidence and the existing venues. Now, here's the shadow data. You know I love the shadow data. Because when you put these two facts together, the Secaucus matching engine and the tighter listing standards, you see what the TXSE is actually designed to do. TXSE is not a regional challenger. It's a premium institutional venue deliberately engineered to pull the highest quality order flow away from NYSE and Nasdaq without any of the friction that a true geographic alternative would impose. The co-location in Secaucus means institutional desks and high-frequency firms can route to TXSE without incurring a latency penalty. The tighter listing standards mean the exchange's tape will carry higher quality securities, the kind that attract institutional allocations, not the blank check shells and low float names that have crowded the lower rungs of the NASDAQ listing ladder. And the backer list confirms that strategy. BlackRock manages over $10 trillion in assets. Citadel Securities executes roughly 25% of all U.S. equity volume. When these two entities are investors in a new exchange, they're not making a passive financial bet, my friends. They are infrastructure participants with the ability and the incentive to route significant flow from TXSE to TXSE from day one. That routing doesn't need to be large in percentage terms to have a structural effect on NYSE and Nasdaq economics. The broader migration is already underway. Financial services gross product in Texas grew 121% over the past decade, compared with 72% in New York. Charles Schwab relocated to Texas. Goldman Sachs built a major operation hub in Dallas. JPMorgan expanded significantly across Houston and Dallas. The institutional talent and capital base that TXSE needs to seed liquidity is already there. The exchange is not creating this migration. It's formalizing it into a trading venue with national regulatory standards. Here's what happens next and why it matters for your portfolio. Exchange economics are not linear. They are network effects. A stock exchange is only as valuable as liquidity it attracts, and liquidity begets more liquidity. The critical threshold for TXSE is not Monday's launch. It is the September ETP launch and the October corporate listing window. Monday is the proof of concept. September and October are the revenue test. Because if TXSE successfully lists ETPs in September and dual lists corporate securities by October, the volume dynamic changes materially. And here's what that does to the incumbents. NYSE and Nasdaq generate revenue from three primary sources: transaction fees, listing fees, and data fees. Transaction fees are directly tied to volume. Listing fees are tied to the number and quality of listing companies. Data fees are tied to the breadth of securities on the tape. Credible competing venue backed by the largest asset manager and largest market maker in the country applies pressure to all three revenue lines simultaneously. Intercontinental Exchange, ICE, the parent of NYSE and Nasdaq Inc., both trade as public companies. Their equity valuations embed an assumption of continuing duopoly pricing power. If TXSE successfully captures even a single-digit percentage of U.S. equity trading volume by the end of this year, that assumption gets repriced. And you know what repricing means, my friend. And repricing exchange economics is not a minor event because exchange multiples are built on the presumption that the moat is permanent. The financial press called it Monday a regional curiosity. The backers, BlackRock, Citadel, JPMorgan, Goldman Sachs, and Bank of America put $270 million into the curiosity, and their primary matching engine is not in Dallas. It's in Secaucus, in the same data center cluster as the exchanges they are competing against. Those names don't write nine-figure checks for stunts, and they don't build infrastructure inside the enemy's fortress unless they plan to use it. So your truth bomb for today is this: the Texas Stock Exchange is not a regional story. It's not a political statement. It's a $270 million institutional bet that the NYSE and the Nasdaq duopoly has been overcharging for decades. And the backers have enough volume to make that bet pay off by routing it themselves from a matching engine that they built inside the incumbent's own data center. Join me every day for Wall Street Truth Bombs, where I drop them right here before the market figures them out.